In this video, I'm gonna show you how I successfully trade the wheel option strategy. I'm gonna show you how I do this on blue chip stocks, really quality household names, and I've managed to generate about 300K in premiums so far this year. And I'm gonna show you step by step exactly how I do it as a professional options trader. So let's go ahead and dive into it. Remember, this is not financial advice. I'm just sharing what I'm personally doing for educational purposes only. Results may vary. Now, all right, so let's take a look at my account. As you can see right here, this right here is my account. And if you wanna follow me along my 8-figure journey, be sure to be subscribed by clicking that subscribe button down below. Also, if you do get any value out of this video, all I ask is that you give it a big thumbs up. I appreciate you being here. So we're gonna go to the realized gain loss because I wanna show you for documentation purposes my current year, okay? In this portfolio, as you can see, current year, we are up about 312K in premiums, okay? This is all collected from selling cash secured puts and doing covered calls, all right? Obviously, I add in a few other strategies, which I'll show you towards the end, but a majority of this, I would say 95% of this is generated from the wheel strategy. So let's go ahead and dive into it, exactly how I do it. Also, if you do want my free trade ideas, that'll be down below on my Instagram and my free newsletter. And if you do want to work with me one-on-one later on down the line, we have 353 clients right now that I work with one-on-one. That'll be at the top of the description, optionstradinguniversity.com. We even have some of our client testimonials right here, but let's go ahead and dive into it. So how did I collect 300K in premiums? Well, it came down to 4 principles, okay? And the first one we're gonna go into is actually the most important. I wanna put the most important one up front because not a lot of people talk about this on YouTube. And this one has led to my success with options trading. So number 1 is understanding the VIX, which is the fear and volatility index of the S&P 500, and capital allocation, okay? This is something that the largest hedge fund managers do, and even Warren Buffett, right? When you hear, oh, Warren Buffett has XYZ amount of cash, well, there's a reason that he does that, and I'm going to show you how I do it in my portfolio. Now, number 2 is understanding overall macro environment. Are we in a bull market, a bear market? That's really going to be important with your strategy selection, and obviously understanding how a trade could go against you because of the overall markets, okay? Number 3 is understanding and identifying key levels on the chart, relative strength index, Bollinger Bands. We're gonna go into a couple of indicators that I actually put on my charting tools that I feel are most important with this strategy. And then number 4 is choosing the right option strategy. So 90% of the time I'm selling options, and then 10% of the time I'm buying options. So I'll show you exactly how I do both. So let's go ahead and jump into the first slide. Now, understanding the VIX, okay? So we're gonna take a look at the chart, all right? We're gonna go to QQQ first, and I wanna show you key moments where most investors, especially average investors or beginner traders, okay, are going all in on their positions. Maybe it's in an individual stock, but they're not looking at the overall markets, okay? A lot of people are fully invested right here, okay? They're fully invested right here, and they're fully invested right here, which is where we are at now, okay? Now, there's a problem with being fully invested if you are an active trader. If you are a passive investor and you're not gonna look at your portfolio for 5 years, then this doesn't apply. But if you're someone who is looking to extract premium out of the market or make successful trades, whether it's a swing trade or even a day trade, then this really matters, okay? So we're gonna take note of these dates, all right? July 10th was a peak right here before we had the Japanese yen carry trade crash in August 2024. So July 10th, okay? Then we're gonna look at December 16th and February 18th, and then we're gonna look at today. And I'm gonna look at the VIX, okay? The fear and volatility index tells us when people are very greedy, investors are extremely greedy, and there's just pure confidence in the market, and when people are fearful. Now, if we go based off of Warren Buffett's saying, be greedy when others are fearful, and fearful when others are greedy, we're gonna look at where the VIX is. So when VIX gets below 15 and it gets into the 14s or even lower, I've seen it as low as 9, that means there is so much greed and confidence in the market that any little piece of bad news can make the market fall, okay? So we're gonna look at that date, July 10th, all right, 2024, which was back here. All right, July 10th was around here, and we were trading at a VIX of 12, okay, 1242, so well below 15. And a lot of investors were fully invested because the market just kept going to new all-time highs, right? Oh, new all-time high, new all-time high. So people get FOMO, or fear of missing out, and they don't want to miss out on more potential gains because they think the market is just going to keep going up like this. So when the VIX is at these levels, okay, that is when I follow my VIX cash allocation principles, which we talked about here, okay? So when VIX is high, options premiums are usually overpriced, and because, options are fear-based products, therefore giving you a key advantage as an option seller, okay, giving you edge. So when VIX is between 10 and 15, I typically have 20 to 50% of my portfolio in positions, and then 50% or more in cash, okay? So having cash on the sidelines when VIX is low and confidence and greed are at their highest, okay? Now, when VIX is 15 to 20, there's slight fear in the market, so I like to have 50 to 80% of my portfolio allocated towards positions, or 20% or more in cash. And then when VIX is at 20 to 30, so there's a lot of fear in the market, that's when I typically go all in, 100% allocated. And a 30 plus VIX is extremely rare. We only see that during massive market crashes or even bear markets. And that's when I'm transferring new money from checking savings into my brokerage because I'm already fully allocated, okay? So let's take a look back at VIX and see where we were July 10th before the Japanese yen carry trade crash, okay? So again, we were at VIX 12. So that's telling me there's extreme greed in the market, and look what happened, right? Bad piece of news comes out, VIX starts trending upwards, and then VIX goes all the way up to 65, okay? And basically that was a perfect time. VIX went 65. The market crashed about 15%. QQQ went down 15%, and that was a bottom in the market. So we've only seen VIX above 60 in the past 5 years about 3 times, right? During the tariffs crash, during that Japanese yen carry trade, and during COVID, which we didn't even see VIX go up to 60 during the bear market in 2022, okay? So that was a point where when the VIX is above 15, okay, we start allocating more cash. We allocate more here, we allocate more here, and then we allocate the last bit here with some new money, right? Transferring from my checkings and my savings. And then look what happens. The VIX comes back down, right? Fear subsides and the market goes back up, okay? So we wanna make sure to have appropriate levels of cash in our account when we're trading. We don't wanna be, deploying all our cash into trades when the VIX is super low and the market's at all-time highs, kind of like we're seeing right now, okay? So right now I have about 20% in cash, okay? Because VIX is right at 15, so I have 20% in cash, ready to go if the VIX spikes further and the market downturns, okay? Because the market could downturn at any time, and I wanna make sure that I'm able to take advantage as an option seller because I could collect more premium on put options when the fear is higher. People have to pay more money, just like car insurance, right? Like if, for instance, a specific model of car gets into a lot of accidents, the premiums on that car, the insurance on that car will be more expensive for the person who wants to drive that car. So it's the same thing in the markets, all right? So let's go ahead, and now that you understand VIX, capital allocation, not being 100% invested at the top, okay, that's very important because you will have a lot of success and be able to take advantage of any corrections or dips, okay? So now that we understand the VIX, capital allocation, just like hedge fund managers, now we can move on to understanding macro environments, all right? So right now we're currently in a lowering interest rate environment. In fact, the day I'm making this video, in 1 week, we will have a potential quarter basis point interest rate cut or even a 50 basis point interest rate cut in the markets. What does that mean? Okay, so basically the Fed will lower the interest rate on which banks can loan out money. So if the interest rates are lower, that means it's cheaper for businesses to borrow, right? Expand their business. They could borrow more funds at cheaper rates. They could hire more employees. They could invest more in research and development and expansion. And that's good for the economy. That's good for businesses, right? It's also good for consumers because consumers can then borrow, do mortgages, car loans, personal loans, right, at cheaper rates and spend more money. And that money ultimately comes back to businesses and goes into the stock market. So that's typically why we see the stock market go up during interest rate lowering environments, okay? Now, how do we check this? Well, there's gonna be a tool called the CME FedWatch tool, okay? Now, this is what it looks like. You can find it at cmegroup.com, okay? And I look at this on a weekly basis, all right? It's gonna show you the current rate. So current target interest rate right now is 425 basis points to 450, okay? So 4.25 to 4.5 interest rate. Now, as you can see, if you click on aggregated, it's gonna show you the dates of all the Fed meetings. So when Jerome Powell, the current Fed chairman, and all the other Fed board, right, governors, they will come and meet and say, hey, do we need to lower interest rates to stimulate the economy? And the next meeting is September 17th. And it looks like there's a 91% chance we're going to get a quarter basis point rate cut, okay? An 8% chance of a 50 basis point rate cut, so half a percentage rate cut. Now, what does this mean? Okay, well, that means there's a good chance, right? If this number is above 55% going into a Fed meeting, there's 100% odds that we're getting a rate cut. This has been proven true since 1998 using this tool. So it's a very accurate tool, and it looks like we're getting a rate cut in September, a rate cut in October, a rate cut in December, and then next year we might get even more rate cuts, 1, 2, 3 more. So it looks like for the next year and a half, 2 years, we're going to be getting a lot of rate cuts, which is going to stimulate the economy, okay? So with that being said, the market is most likely going to go higher. Now, I've seen it the opposite. I've seen when the rates get hiked and they go higher, and that's actually when the 2022 bear market started. So that told me, hey, I need to get rid of half of my positions, right, and free up some cash because the market is most likely going to go down now that the Fed is hiking rates. So this is something you have to keep in mind when trading individual stocks, because if the overall market is going down, your stock that you're trading is most likely going to go down, okay? The market will bring down everything, and you don't want to be stuck in bullish positions when the overall market is tanking. So a very good tool that has helped me become a successful options trader and primarily options seller, okay? Now, there's also macro headline risk. Like, for instance, the most recent one that we encountered was Jerome Powell potentially saying there wasn't going to be a rate cut in September. So I'm going to go back here. At this point right here in the markets, okay, it was around, mid-August. He was going to a meeting in Jackson Hole, Wyoming, okay, called the Jackson Hole Economic Summit. And he was going to talk about potential interest rate cuts. And people were afraid that he was going to say, hey, we're not going to do rate cuts in September. And the market started selling off because of that risk, okay? So that's headline risk, right? You have to be aware of those opportunities. I think when the market goes down, that's an opportunity to sell cash secured puts, which I'll talk about in a moment. But we want to be aware of that because you don't want to be long going into, or you don't want to be fully invested going into events that could make the market go down, okay? So that's going to be macro headline risk. And then we're going to take a live look at the charts, okay? So the trend is your friend. Obviously, if you look at the long-term chart, you see that we are going upwards, okay? We've had these periods of downwards action, crashes, and usually when, the overall market breaches below this blue line, which is the 200-day moving average, you could click on indicators on TradingView and just type in 200 at 200-day SMA, and you could just click on that, all right? And that's gonna pop up this line. That's kind of a bearish scenario, okay? So right now we're well above the 200-day moving average, and it looks like we're just kind of pushing higher, okay? So market's looking good right now. Now, let's talk about the RSI, Bollinger Bands, and just key indicators on the chart, okay? So we're gonna go on to the chart, and we're just gonna type out, the first indicator I want you to type out on TradingView is Relative Strength Index, okay? You could find that here, Relative Strength Index, and that's gonna pop up this indicator right here. Mind you, these are all lagging indicators, so this is not gonna be, end all be all. This is just helping us make trading decisions, but it's not going to be the main driver of the decision, okay? So that's the RSI, the Relative Strength Index. Then you're gonna type in MACD, okay, MACD, Moving Average Convergence Divergence. That's a momentum indicator. That's this one right here, all right? And then lastly, you'll want to type in Bollinger Bands, okay? Bollinger Bands, these are my favorite. And you'll click on that, and that'll pull up these bands right here. So what Bollinger Bands are is basically it's a statistical indicator that is the upper and lower band are 2 standard deviations away from the average price of the stock. Or, easier terms, there's a 95% chance that the stock is going to stay in between these bands, right? And a 5% chance that it will breach either the upper band or the lower band. But when that happens, it usually sucks back in. As you can see, it breached the upper band here, sucked back in, breached the lower band here, sucked back in, okay? And even during the tariffs crash, we saw it breach the lower band by a lot right here, but it sucked back in, okay? So this is kind of my favorite indicator to take advantage of key opportunities, like when we breach lower Bollinger Bands, okay? So that's gonna be the 3 indicators. Now, let me talk about the RSI now that we've talked about the Bollinger Bands. The RSI is a cool one because it shows you when we're overbought or oversold. Very simple. If the line is above 70, we're overbought. If the line is below 30, we're oversold. Now, we were oversold once during that tariffs crash, April of 2025, okay? And that was a good opportunity to start getting long because you want to be greedy when others are fearful. Everyone was fearful. They thought the market was gonna head lower right here, and we're oversold. So that was a good indicator to say, hey, we breached lower Bollinger Band. That's a outlier move. Only 5% of the time that happens. This is a good time to buy because most likely we're going back up, right? 95% chance. Okay, so the RSI helps you do that. So another thing on this is the yellow line. When this purple line crosses the yellow line, that's usually a bullish indicator. So it crossed, on September 4th right here, crossed over. And as you can see, the market went back up, okay? Another thing is we're gonna move on to the MACD because this crossover is even more important. So the MACD is a momentum indicator, and when the blue line crosses that little orange line, let me just grab this here so you can see, okay? When this blue line crosses the orange line like it just did not too long ago on September 9th, okay, that's a bullish indicator, okay? That's a bullish momentum indicator right there. And as you can see, the market started turning back up. So you could combine all of these, right? You could say, oh, wow, the QQQ crossed this lower Bollinger Band right here. But there's a bullish crossover on the RSI and a bullish crossover forming on the MACD. That tells me, hey, this might be the time to get back into the markets for a bullish trade, all right? And that would have worked out very well, okay? Now we're approaching the other end. This thing could go higher to overbought, and MACD could be very overextended on the bullish side, like right here. And once it starts tapering down, and same here, once the RSI starts tapering down and it crosses back over this yellow line, it's usually when we see these dips, okay? So I'm expecting a dip in the next couple weeks, a healthy dip, but those are key opportunities to buy up. So that is gonna be all the charting indicators you need. You don't really need much more. Of course, I have like the 50-day moving average, which is this yellow line. The mid Bollinger Band line is actually the 20-day moving average. And then I like to have this 200-day. So those are 3 moving averages that, typically when these things kind of get coiled together like this, it's kind of a bearish signal like, hey, there might be a bigger drop in the market. But right now, all are spaced out pretty well. 20 days above the 50 is above the 200. So it looks pretty good. Like we have a lot of bullish momentum here in QQQ, which tracks the NASDAQ 100. Okay, so that's how to use all of the charting indicators. Very basic, but it gives me a good idea of, is this the right position to take? Okay, so now the last part is choosing the right option strategy. Now, I'm a option seller. The reason I like option selling is because when I sell an option, I am credited a premium upon selling that option. So I'm getting paid a premium upfront to sell an option that is most likely going to expire worthless. If it doesn't expire worthless, I'm going to be assigned 100 shares. That's fine. And I got paid to do it. I got paid to basically dollar cost average into a good stock. So when you're first trading options, you should not be buying them. Most people do. And that's where you can lose a lot of money. I lost a lot of money buying options as a beginner because I didn't understand how they moved. I think that I should be selling them via vertical spreads. So when I started off with a small account, I was doing vertical spreads, which is a video on my channel called vertical spreads. You could just search it, options with Ryan, vertical spreads, or cash secured puts. Now I do cash secured puts and covered calls, typically with an account over 50K. That's going to be the main strategy, okay? It's going to be a lot harder to do it when you have an account that's less than 25K. Anything above 25K, you could do cash secured puts, which is what I'm going to talk about, okay? Vertical spreads are fine too. You could do those as well. So this ensures you're winning 80 to 90% of the time versus losing 50 to 75% of the time with buying options and relying on stop losses. I do not set stop losses because I don't need them. My stop loss is, hey, I get assigned the stock and I have a good asset that I got at a cheaper price and I got paid to do it. Okay, so you could buy options when you get more experience, and I'll go over an example of how I do options buying. Okay, so let's talk about cash secured puts. What do I mean by that? Well, let's just say the stock is trading, let's just say it's trading somewhere around 100, okay? I'm gonna sell the 90 put option. So this is basically, I'm selling an option to someone that's purchasing it from me, right? They're buying a put because they're bearish on the stock short term. They want an insurance plan. Maybe they've owned this stock since $20 and now it's trading at 100, but they don't want to lose too much. They said, hey, if this stock goes below 90, I want out of my shares. And basically I'm saying, hey, I'll buy your shares at 90. If it goes down there, there's only a 20% chance that it will. And if it does, I'll buy them. I'll be your insurance plan. I'll buy the shares at a discount, right? So it's a win-win. They buy the option from me, the put option. And if it goes down to 90, down to 85, right? I'll buy their shares at 90. They only lose $10. They paid, they paid that premium to me for that option. And then I'll buy their stock at a discount and they get relieved of their shares, okay? So what's cool about this is that, I'll do this for many months straight. So let's just say the stock's trading at 100. I'll sell the 90 put option, kind of like an insurance plan, right? Like for a car insurance, we pay for car insurance every month, but we probably never use it, right? And we'll probably pay more car insurance premiums than the car is actually worth throughout our lifetime. So it's the same thing. People are paying me a premium for these options, and most of the time they expire worthless. So let's just say the first month, the stock in 30 days trades down all the way down to 94. Cool. Didn't go past 90, my put price. I keep the premium and I'm selling another 90 strike put option the next month. Let's just say the next month it goes back up to 102. Cool. I collect that premium on the 90 put option because it expired worthless, and I do it all over again. Let's just say the third month I sell that 90 put option, but the stock falls all the way down to 85. Okay. Now I'm forced to buy 100 shares at 90. So that's going to cost me $9,000. All right. But I got paid that premium. Let's just call it $500 to buy my favorite stock at $90. So it's a win-win, right? I got a stock at a discount from 102 all the way down to 90, and I got paid to do it. So that's exactly how it works. And then once you have those shares, there's a way to generate income via selling covered calls, and I'll get into that in just a moment. So I'm going to show you exactly how I'm selling 25 to 30 delta puts. Delta means the percentage chance that it will actually be in the money by expiration. So you'll have to buy 100 shares. So let's go back to that. 25% chance is going to be a lower chance that it's going to be assigned, but I would collect less premium because I'm taking less risk. Now, if I go closer to the money, closer to where the stock's trading, let's just say a 35 delta put, so it has a 35% chance of being in the money, I will get paid more premium, okay? So there's a trade-off, right? You're close, you might get assigned, but you get paid more premium. So I'm gonna show you exactly what I mean by that. I typically go 30 days out for monthly income. And then, my goal is 3 to 5% on these cash secured puts per month, okay? 3 to 5% per month. That's how I've been able to do like 45% returns, okay, yearly. So must have a good chart, good PE ratio, and I'll show you a live example, okay? So one of my favorite stocks is Robinhood, all right? Beautiful chart, upward trending for the past year and a half, even longer, but I like to look at the past year and a half, because if we go to stocks like AMD, which is a great company, but the chart is just, downward trending for the past year and a half, as you could see, just kind of going downwards, this stock is not good to trade the wheel strategy on, because you're going to get assigned here, and then it's just going to keep going against you, and you're losing money, and you can't collect any covered call income because the stock goes so far down, okay? Whereas Robinhood, okay, this thing, okay, maybe if you got assigned here, right, it kept going down during that crash, but then it went back up and recovered, went to new all-time highs, and more new all-time highs, and more new all-time highs, okay? So we want easy stocks to trade like this with good upward trending charts. PE ratios below 100. This one's at 59, right? And it's a growth company in a space that's very profitable, which is the financial sector, okay? And that benefits from interest rate cuts. So with that being said, we're gonna go to my account, okay? Remember, this is not financial advice. I'm just sharing this for educational purposes. But if you look at my Robinhood position, I currently have 160,000 of cash secured puts. I'm very bullish on Robinhood, and I'm collecting premium. As you can see, the current monthly premium collecting is about 6,600, okay? So if I were to sell a new put option on this stock, I would go out 30 days, October 10th, and I would go to the 30 delta, right? 25 to 35 delta, depending on how bullish I am. I'll just go to the 30 delta, which is the 109 strike, and I would collect a potential premium of 3.98% in 30 days. Results vary based off where the stock is trading, okay? But if we go back to the chart, 109 is about right here, okay? All the way down here from current prices. So if we take a look at, how far the stock would have to fall from here, it would have to go down about almost 7.5% in 30 days for me to get assigned 100 shares. If it doesn't, I collect that premium. If we take back a look, that's a $380 premium that I get to keep, or a $410 premium I get to keep, okay? So that's the risk there. From all-time highs, that would be a 11.8% discount. So I like that. I like that discount, and that's a good, pretty decent strike price that's semi-safe for me, okay? So you'll have to decide where you want to go dependent upon your risk. 25 delta would be the 106 strike, and that would, pay out less. Obviously, if we go back here, it's a potential 3.2% ROI, but on the downside, okay, 106 would be a 13% discount, almost 14% discount from all-time highs, okay? So that's the trade-off, all right? But I like that trade-off, and that's how I do it every single month with many stocks in my portfolio, as you could see, right? If we go back to my main positions, I have many stocks that I do this on. And again, if you haven't subscribed, be sure to, because I show exactly how I do all of this. But that's gonna be the cash secured put. Now, let's talk about covered calls, all right? Let's just say that third month I'm selling puts and the stock falls down below, let's just use the Robinhood put example. It falls to 103 and I was assigned at 109. So now I have 100 shares at 109, okay? Now I'm gonna have to sell covered calls against my shares. Now how this works is if I have the shares right here at 109, I'm gonna be trying to sell covered calls above my cost basis, so at like 110, 111, 115, somewhere up here. And as long as the stock doesn't go past that, I get to keep collecting that income. If the stock goes past that, okay, like let's just say I sell the 115 covered call and it goes past that, now I'm forced to sell my shares at a profit from 109 to 115, so I have to sell them at 115, and I got paid a premium, so it's double the income there. So I like that, right? That's why I love covered calls, because you're collecting premiums and stock appreciation. So typically I'll sell a 30 delta. I'll go 20 days out. I'll go a little shorter so I could do it more frequently. And then I like to enter in on a green day when the stock is up so I could get a little bit further out and get more share appreciation if the stock goes past my covered call strike. But let's go to Robinhood again, and we'll just pretend that we got a sign today at 117, okay, the current price. So I'm gonna go out about 20, let's just go out 23 days, okay? Sometimes I go 15 to 25 days, somewhere in that range. But we'll go out 23 days, and I'm gonna go out to like the 30 delta. There is no 30 delta, there's a 28 delta, or we could go straight to this 37 delta. That's fine there. I'll go to the 37 delta. I'm gonna collect about $4 there, so 400 bucks. It's almost a potential 4% ROI on these covered calls, but if the stock goes from 117 to 125, right, that's about what, a $7, $8 appreciation, right? So I'm not only collecting $8 in appreciation or $7 in appreciation, but I'm also collecting this $4 premium. So that comes out to about, almost a 7 to 8% return, right? Potential return. So that's what I love about the covered calls. I would sell one of these, and if the stock goes above 125 in 23 days, then I'll have to sell the whole position, right? Sell the shares at a profit, and the option will expire, and I'll collect the premium. And now I have cash to do the cash secured put all over again. That's why it's called the wheel strategy, okay? So that's exactly how I do the covered calls. Now let's talk about buying options, because this is a fun one. And a lot of people are intrigued by how much you can make when you buy options. Well, I'm gonna show you how I do it and how I do it safely in my own way. So what I like to do is buy a 70 delta LEAPS call option 1 year out. So a LEAPS is a long equity anticipation security, which is basically a call option that expires in 1 year or more, okay? Stock has to be below the lower Bollinger Band or at the middle Bollinger Band when VIX is above 15, and sell once the stock is above the middle Bollinger Band. So I'm gonna talk about Robinhood because we did this to the T, okay? I did this not just last week. So I got in right here. The stock went below the lower Bollinger Band. So I got in to a LEAPS option, a call option right here when the stock was at 97. And then over the weekend, the stock happened to be included into the S&P 500. And I basically got out right here when it was at 113. So I got out, I was up 31% on my call options overnight, okay? Now this doesn't happen all the time. Usually it goes a little bit slower than this, and maybe happens in 3 weeks or 3 months, right? But sometimes we get lucky and we have this happen. So it has to meet that criteria. It has to be at the lower Bollinger Band or at least below the middle Bollinger Band, like somewhere in here. And then you sell when the stock goes back up towards that upper Bollinger Band. So on Robinhood, like right now would not be a good entry, but we'll just use it as an example. I like to go out 400 plus days. So I would go out January 15, 2027, and I would go to the 70 delta and pay $4,000 to buy the 105 call option, okay? Now, it's cool because I paid $4,000 to control 100 shares versus buying 100 shares right now would cost me $11,700. So I'm levering up my money almost 3x, right, to hold 100 shares. So that's why I like doing this. Also, the theta decay, which is the time decay that comes out of these options, because when you're buying options, it's working against you every day that goes by. I'm losing $3 per day, $3.19 on this option. But if I were to go to a short-term option, like a lot of people do, like a 30-day or 60-day, right, on that same 70 delta, okay, I'm losing about $12 per day. So I'm literally losing 4 times as much as I am because on this one, because I paid for more time. That's why I like to pay for more time, give myself ample amount of room to be right. Because if I go do a 30-day, 90-day, 120-day option and the stock moves against me, well, I have a very short window to be right. Versus if I have 2 years, the stock's most likely going to rebound from any black swan event. So that's why I go so far out in time. But again, that's how I lever up my money sometimes. And I only use 10% of my portfolio value for LEAPS call options. So just be mindful of that. But if you enjoyed this video and you want to watch my LEAPS masterclass, I filmed that right here. This is an in-depth tutorial on exactly how to do LEAPS the real way. I showed you a brief overview in this video, but this is the masterclass video. So watch this one, and I'll see you in the next one. Take care.